I need to warn you about something that almost nobody in the financial industry is willing to say out loud. Your 401k, the retirement account that you have been faithfully contributing to for years, possibly decades, is in serious danger. And I am not talking about normal market volatility. I am not talking about a temporary correction that will bounce back in a year or two. I am talking about structural problems that threaten to erode your retirement savings in ways that most Americans do not understand and are completely unprepared for. I have been managing money for over 40 years. I have navigated every kind of market environment: bull markets, bear markets, crashes, recoveries, inflation, deflation, currency crises. I have seen it all. And what I am seeing right now keeps me up at night. The combination of factors threatening the typical American 401k is unlike anything I've witnessed in my career. And the financial industry, the same industry that profits from your contributions, has no incentive to tell you the truth. Let me be very clear about something from the start. I am not trying to scare you into making rash decisions. I am not selling you anything. I am not telling you to empty your 401k tomorrow. What I am doing is sharing an honest assessment of the risks that I see, risks that I believe every American with a retirement account needs to understand. Because once you understand these risks, you can take steps to protect yourself. But if you remain ignorant, if you keep doing what the financial industry tells you to do without questioning it, you could find yourself at 65 or 70 with far less money than you expected and far fewer options than you deserve. Let me start with the first danger, and it is the one that almost nobody talks about. The 401k system itself was never designed to be the primary retirement vehicle for American workers. It was created in 1978 as a supplement to pensions and Social Security, not a replacement for them. But over the past 4 decades, corporations have systematically eliminated traditional pension plans and shifted all the risk onto workers. Today, the 401k is the only retirement plan most Americans have, and it was never built to carry that weight. Think about what has happened. In 1980, roughly 60% of private sector workers had access to a traditional pension, a defined benefit plan that guaranteed them a specific monthly payment for life. The company took on the investment risk. The company guaranteed the income. You worked your years, you retired, and you received a check every month until you died. That was the deal. Today, only about 15% of private sector workers have access to a traditional pension. For everyone else, the 401k is it. And unlike a pension, the 401k puts all the risk on you. You have to decide how much to save. You have to decide how to invest it. You have to hope the market cooperates. You have to figure out how to make it last for potentially 30 years of retirement. And if you get any of those decisions wrong, there is no safety net. There is no company standing behind you guaranteeing your income. You are on your own. This shift from pensions to 401k plans has been a massive wealth transfer from workers to corporations. Companies used to bear the cost and risk of funding retirements. Now you bear it, and the financial industry has profited enormously from managing all these individual accounts, charging fees that most participants do not even realize they are paying. Let me talk about those fees because this is the second danger threatening your 401k. The fee structure of most 401k plans is quietly devastating to long-term wealth accumulation, and the way these fees are disclosed makes it almost impossible for the average person to understand how much they are actually paying. Most 401k plans charge fees at multiple levels. There are plan administration fees, there are individual fund expense ratios, there are revenue sharing arrangements, there are 12B1 fees, there are sub-transfer agency fees. The total can easily reach 1.5% to 2% annually, sometimes more, and most participants have no idea. Let me show you what 2% annual fees do to your retirement savings over a career. Say you are 30 years old, you contribute $500 per month, and you average a 7% return before fees. After 35 years, at age 65, you would have approximately $1.1 million if you paid no fees, but with 2% annual fees, you end up with only about $700,000. You have lost $400,000 to fees. Nearly 40% of your potential wealth, gone $400,000. That is not a rounding error. That is years of retirement income. That is the difference between traveling and staying home, between helping your grandchildren and asking them for help, between dignity and dependence. And the financial industry took it from you one small percentage point at a time, year after year, while telling you that you were doing the right thing by saving for retirement. Now, some of you might be thinking that your plan is different, that your fees are lower. Maybe they are, but I would challenge you to actually find out, look at your 401k statement, try to find the total then costs you are paying. Most people cannot do it because the disclosures are deliberately confusing. The fee information is scattered across multiple documents and language designed to obscure rather than illuminate. This is not an accident. The financial industry has fought every attempt to require clear, simple fee disclosure. They know that if people understood what they were paying, they would demand lower cost options. So they keep it complicated, they keep it hidden, and they keep extracting billions of dollars from retirement savers who do not know any better. The third danger to your 401k is the limited investment options in most plans. Unlike a regular brokerage account where you can buy almost any stock, bond, or fund, your 401k typically limits you to a menu of perhaps 20 to 30 options selected by your employer and the plan administrator, and often those options are mediocre at best. Many 401k plans are stuffed with high-fee, actively managed funds that consistently underperform simple index funds. Why? Because the fund companies pay to be included in the plan. It is a form of legal kickback. The plan administrator gets revenue, sharing payments from the fund companies. In exchange, employees are stuck with expensive, underperforming investment options. I have looked at hundreds of 401k plans over the years, and the pattern is consistent. The cheapest index funds, the ones that would serve employees best, are often missing entirely. Instead, you get actively managed funds charging 1% or more that lag their benchmarks year after year. The plan sponsor and administrator profit, you lose. And even when decent options are available, most participants do not know how to construct a proper portfolio. They put everything in whatever sounds safest, or they chase whatever performed best last year, or they pick target date funds that are often more expensive and less effective than a simple index fund portfolio. Without proper guidance, which most plans do not provide, employees make suboptimal decisions that cost them dearly over time. The fourth danger is perhaps the most important, and it relates to the broader economic and fiscal environment we are entering. I have been warning about this for years, and the situation has only gotten worse. The United States government is on an unsustainable fiscal path that threatens the value of every dollar-denominated asset, including your 401k. Let me give you the numbers because they are staggering. The federal debt is now over $34 trillion. That is trillion with a T. The annual deficit, the amount we add to the debt each year, is running at nearly $2 trillion. Interest payments on the debt alone now exceed $800 billion annually, more than we spend on defense, more than we spend on Medicare. And here is the truly terrifying part. These numbers are going to get much worse. The Congressional Budget Office projects that annual deficits will exceed $2 trillion for as far as the eye can see. By 2034, just 10 years from now, the debt is projected to exceed $50 trillion. Interest payments could exceed $1.5 trillion annually. This is not sustainable. Something will have to give. And there are really only three ways out of this mess. The government can cut spending dramatically. The government can raise taxes dramatically. Or the government can inflate away the debt. Cutting spending is politically almost impossible. The biggest drivers of the deficit are Social Security, Medicare, and interest on the debt. No politician will touch Social Security or Medicare because seniors vote, and interest payments are contractual obligations that cannot be reduced without default. Raising taxes is also politically difficult, though more likely than spending cuts, but the taxes would have to be enormous to close a $2 trillion annual gap. We are talking about doubling income tax rates or imposing new taxes that would fundamentally change the economy. And here is what affects your 401k directly. One of the most frequently discussed options is changing the tax treatment of retirement accounts. Right now, your traditional 401k contributions are tax deductible. You get a tax break today in exchange for paying taxes when you withdraw the money in retirement. But what if the government changes the rules? What if they cap the tax deduction? What if they impose new taxes on retirement account balances? What if they require earlier withdrawals at higher tax rates? These are not hypothetical concerns. Politicians from both parties have proposed various changes to retirement account taxation. When the government is desperate for revenue, your 401k is a tempting target. Trillions of dollars sitting there, sheltered from taxes, representing a potential windfall for a cash-strapped treasury. Do not assume the tax rules that exist today will exist when you retire. But I think the most likely outcome, the one the government will ultimately resort to, is inflation. Inflating away the debt is the path of least resistance. You do not have to pass unpopular spending cuts. You do not have to raise taxes explicitly. You just let inflation run a little hot. Let the purchasing power of the dollar erode, and the real value of the debt shrinks over time. This is exactly what happened after World War II. The debt-to-GDP ratio was over 120% in 1946. By 1970, it was down to 35%. Did we pay off the debt number? We inflated it away. We let inflation run. We let the economy grow in nominal terms, and the debt became manageable. I believe we are heading for a similar period of elevated inflation. Not hyperinflation, not Zimbabwe or Venezuela, but sustained inflation of 4, 5, or 6% annually, well above the Federal Reserve's 2% target. And this kind of inflation is devastating to retirement savings. Let me explain why. Most 401k participants have significant allocations to bonds and bond funds. These are supposed to be the safe part of the portfolio. But bonds get destroyed by inflation. When inflation rises, interest rates rise. When interest rates rise, existing bond prices fall. We saw this in 2020. When the bond market had its worst year in recorded history, investors who thought they were being conservative lost 20 to 30% in their bond funds. But even if you hold bonds to maturity and get your principal back, you have lost purchasing power. If you buy a bond yielding 4% and inflation runs at 5%, you are losing 1% per year in real terms. Your money is worth less every year. Over a decade or two, that erosion is devastating. Stocks can provide some inflation protection because companies can raise prices and earnings can grow, but not all companies can do this equally. Companies with pricing power, with strong brands, with essential products, can pass on cost increases to customers. Companies without these advantages get squeezed between rising costs and resistant customers. Their profits shrink. Their stock prices fall. The typical 401k, with its limited investment options and cookie-cutter allocations, is not positioned to navigate an inflationary environment. Most target date funds, the default option for millions of Americans, have huge allocations to bonds that will get crushed by sustained inflation. Most participants do not have access to inflation-protected securities, commodities, or other assets that can hedge against purchasing power erosion. The fifth danger to your 401k is the coming entitlement crisis and what it means for Social Security. Most Americans assume that Social Security will be there when they retire. They factor it into their planning. They assume that between Social Security and their 401k, they will have enough. But the math does not work. The Social Security Trust Fund is projected to be depleted by 2033, that is less than 10 years away. When the trust fund runs out, by law, benefits will have to be cut to match incoming tax revenue. The current projection is a 23% benefit cut. If you were expecting $2,000 per month from Social Security, you might only get $1,540. Now Congress might act to prevent these cuts, but the only options are raising payroll taxes. Raising the retirement age means testing benefits or some combination. All of these options hurt someone. Raising taxes hurts workers. Raising the retirement age hurts people planning to retire soon. Means testing benefits hurts people who save diligently in their 401k plans. That last point deserves emphasis. If you have done everything right, if you have saved aggressively in your 401k, you might be penalized with reduced Social Security benefits. Politicians love means testing because it sounds fair. Why should wealthy retirees get Social Security? But in practice means testing punishes the responsible and rewards the profligate. If you knew your Social Security would be cut because you saved, would you have saved as much? This is the kind of perverse incentive that means testing creates. The sixth danger is something I have been watching very carefully. The concentration risk in the stock market, particularly in the index funds that most 401k participants own. The S&P 500 index, the benchmark that most large cap funds track, has become dangerously concentrated in a handful of mega cap technology companies. Right now, the top 10 stocks in the S&P 500 represent roughly 35% of the entire index. The top 7, the so-called Magnificent 7 technology companies, represent an even larger share. When you buy an S&P 500 index fund, you are not getting diversification across 500 companies. You are making a massive bet on a handful of tech giants. This concentration has worked wonderfully for the past decade. Those tech giants have delivered spectacular returns. But concentration that helps you on the way up hurts you on the way down. If those companies stumble, if regulation increases, if competition intensifies, if their growth slows, the entire index gets dragged down. And everyone in a 401k with money in large cap index funds goes down with it. I am not predicting that these companies will fail. Some of them are genuinely exceptional businesses, but the valuation levels assume perfection. They assume continued growth at rates that become harder to achieve as companies get larger. Any disappointment, any stumble could trigger significant declines. And most 401k participants have no idea how much concentration risk they are taking. Let me talk about what I think you should do about all of this, because identifying problems without offering solutions is not helpful. And while I cannot give you personalized advice, I can share the principles that I believe should guide anyone concerned about their 401k first. Understand your fees. Go through your 401k statement and fund disclosures with a fine-tooth comb. Add up every expense ratio, every administrative fee, every cost you can find. If the total exceeds 1% annually, you are paying too much. Push your employer for lower cost options. If they do not respond, consider whether the tax benefits of the 401k outweigh the excessive fees. For some people, contributing only enough to get the employer match and then investing additional savings in a low-cost IRA makes more sense. Second, diversify beyond what your 401k offers. If your plan has limited options, use other accounts to fill the gaps. You can open a Roth IRA and invest in assets your 401k does not offer. You can use a taxable brokerage account for additional diversification. Do not let the limitations of your 401k constrain your entire investment strategy. Third, consider the tax diversification of your retirement savings. Most people have all their retirement savings in traditional 401k and IRA accounts. This means all of their withdrawals will be taxed as ordinary income. If tax rates rise in the future, which I think is likely, this concentration could be very costly. Consider putting some savings in Roth accounts where withdrawals are tax-free. Consider Roth conversions in years when your income is lower. Consider building some after-tax savings that can be accessed without the restrictions of retirement accounts. Tax diversification gives you flexibility to manage your tax burden in retirement, regardless of what rates do. Fourth, think seriously about inflation protection. Most 401k allocations have far too much in traditional bonds that will get crushed in an inflationary environment. Look for Treasury inflation-protected securities or TIPS funds if your plan offers them. Consider reducing your bond allocation in favor of stocks with pricing power. Think about assets outside your 401k that provide inflation protection, like I-bonds, real estate, or commodities. Fifth, do not count on Social Security being there at full value. When you do your retirement projections, assume benefits will be cut by 20 to 30%. Plan to fill that gap with your own savings. If Social Security ends up being more than you expected, great. But do not build a plan that depends on full benefits that may not materialize. 6. Consider your concentration risk. If your 401k is heavily weighted toward large-cap U.S. stocks, you might be less diversified than you think. Look at international stocks, small-cap stocks, value stocks, anything that provides exposure beyond the mega-cap tech giants that dominate the indexes. Diversification does not always feel good. Sometimes diversified portfolios lag concentrated ones for years. But diversification is insurance against the scenarios you cannot predict. Seventh, and this is perhaps the most important, take ownership of your financial future. Do not outsource your retirement planning to your employer, your 401k provider, or the financial industry. They do not have your best interests at heart. They have their own interests, which sometimes align with yours and sometimes do not. Learn how investing works. Understand the basics of asset allocation, diversification, and risk management. Know what you own and why you own it. Be skeptical of advice from people who profit from your decisions. Ask questions. Demand transparency. Take control. The 401k was presented to American workers as the path to a secure retirement, and for some people, it has worked. But the system has deep flaws that the financial industry does not want you to know about: excessive fees, limited options, concentration risk, vulnerability to inflation and tax changes. These problems are real, and they are getting worse. I am not telling you to abandon your 401k. The tax benefits in employer matching are valuable, but I am telling you to go in with your eyes open, understand the risks, take steps to protect yourself. Do not trust that the system will take care of you, because the evidence suggests it will not. The people who come through the coming decades with their retirement intact will be the ones who understood the risks and prepared accordingly. The ones who diversified, the ones who managed their tax exposure, the ones who protected against inflation, the ones who did not rely entirely on a flawed system to provide for their future. I have spent 40 years watching markets, studying economic history, and learning from mistakes. And everything I have learned tells me that the next 20 years will be challenging for retirement savers in ways that the past 20 years were not. The easy money from falling interest rates is over. The benign inflation environment is over. The fiscal recklessness is catching up with us. But challenging does not mean hopeless. It means you need to be smarter, more informed, more proactive than you might have needed to be in the past. It means you cannot just set it and forget it. It means you have to engage with your financial future and make thoughtful decisions. The warning I am giving you today is not meant to frighten you into paralysis. It is meant to motivate you into action. Your 401k is in danger, but that danger can be mitigated. The threats are real, but they can be addressed. The future is uncertain, but you can prepare for multiple scenarios. Start today. Review your 401k, understand your fees, evaluate your investment options, consider your tax exposure, think about inflation protection, plan for a range of Social Security outcomes. Diversify beyond what your plan offers. Do these things and you will be far better positioned than the millions of Americans who blindly trust a system that was never designed with their best interests in mind. The 401k is a tool. Like any tool, It can be used well or poorly. Use it well, understand its limitations, supplement it with other strategies, and you can still build the retirement you deserve. But ignore the warnings, trust the industry, and continue on autopilot. And you may find yourself at retirement age wondering what went wrong. I do not want that for you. That is why I am sharing these concerns today. Take them seriously, take action, and take control of your financial future while you still have time to make a difference. Let me go deeper on some of these issues because I think it is important that you understand not just what the dangers are, but how they work and why they exist. The fee problem in 401k plans is a perfect example of misaligned incentives in the financial system. Think about who makes the decisions about your 401k options. It is not you. It is your employer, working with a plan administrator and various financial firms, and your employer's incentives are not the same as yours. Your employer wants a plan that is easy to administer, that minimizes their fiduciary liability, and that does not cost them too much. They are not primarily focused on getting you the lowest fees or the best investment options. They are focused on checking boxes and avoiding lawsuits. As long as the plan meets minimum legal requirements, they are happy. The plan administrators and fund companies have even worse incentives. They want to maximize their revenue, which means maximizing the fees they extract from participants. They package expensive funds with hidden fees. They create complexity that makes comparison shopping impossible. They use revenue-sharing arrangements that essentially kick back money from fund companies to plan administrators in exchange for inclusion in the plan. This entire system operates at your expense. And because most participants do not understand it, because the disclosures are deliberately confusing, because there is no easy way to comparison shop between 401k plans, the industry gets away with it year after year. Billions of dollars flow from retirement savers to financial intermediaries who provide little value in return. I want to tell you a story that illustrates how this plays out in real life. I knew a man, a factory worker, who diligently contributed to a 401k for 30 years. He did everything he was told. He contributed enough to get the full employer match. He put his money in the target date fund that corresponded to his expected retirement year. He never touched it, never panicked during downturns, just steadily accumulated. When he retired at 65, he had about $400,000. Not bad for a factory worker, right? But when I looked at his plan, I was appalled. The total fees, including the target date fund expenses and administrative costs, were running about 1.8% annually over 30 years. Those fees had cost him nearly $250,000. If he had been in a low-cost plan, he would have retired with $650,000 instead of $400,000. That extra $250,000 at a 4% withdrawal rate would have provided him an additional $10,000 per year in retirement income. For a factory worker living on a modest budget, that is life-changing money. It is the difference between just getting by and living with dignity, and he never knew he thought he was doing the right thing. The system took nearly 40% of his potential wealth, and he had no idea it was happening. This story plays out millions of times across America. The cumulative wealth transfer from workers to the financial industry is staggering. And it is completely legal because the system was designed by the industry, regulated by captured agencies, and protected by politicians who receive campaign contributions from financial firms. Let me talk more about the inflation threat because I do not think most people appreciate how serious this is. We had a taste of it in 2021 and 2022 when inflation spiked to 9%. People were shocked. They had grown up in an era of low, stable inflation and assumed that was normal. But it is not normal. It is a historical anomaly. From 1946 to 1980, inflation averaged over 5% annually. There were years when it hit double digits. People who retired in the 1960s and 70s saw their purchasing power cut in half. Within a decade, fixed-income retirees were devastated. This is living memory for many Americans, but it has been forgotten by a generation that grew up with 2% inflation. I believe we are entering another era of elevated inflation. And here is why. The government has made promises. It cannot keep Social Security, Medicare, Medicaid, military pensions, civilian pensions. The present value of these unfunded liabilities exceeds $150 trillion. That is not a typo, $150 trillion in promises that have no funding source. How do you deal with $150 trillion in promises when the entire annual GDP is only about $28 trillion? You cannot tax your way out. You cannot grow your way out. You cannot cut your way out without political revolution. The only way out is to inflate your way out. Make those dollar-denominated promises less burdensome by making each dollar worth less. The Federal Reserve is supposed to be independent, focused solely on price stability and maximum employment. But the Fed is not really independent. Its governors are appointed by politicians. Its decisions are influenced by political pressure. And when the choice is between tight money that causes recession and loose money that causes inflation, politicians will always choose inflation. They would rather have their constituents pay a hidden tax through rising prices than an explicit tax through legislation. This is why I am so concerned about the bond allocations in typical 401k portfolios. Bonds are supposed to be the safe part, the ballast, the anchor. But in an inflationary environment, bonds are anything but safe. They are a guaranteed way to lose purchasing power. Consider this math. You own a bond fund yielding 4%. Inflation runs at 5%. Your nominal return is 4%, but your real return is negative 1%. You are getting poorer every year while feeling like you are earning something. The number in your account goes up, but what that number buys goes down faster. It is an illusion of safety that masks real wealth destruction, and it gets worse during inflation spikes. In 2022, when inflation jumped to 9% and the Fed raised rates aggressively, long-term bond funds lost 20% or more. Investors who thought they were being conservative, who had moved money to bonds as they approached retirement, got crushed. They lost years of savings in a matter of months. The typical 401k target date fund for someone near retirement might have 40 or 50% in bonds. That is massive exposure to an asset class that performs terribly in exactly the environment I think we are heading into. And most participants have no idea. They see bonds as safe. They see the target date fund as the responsible default choice. They do not understand that they are concentrated in an asset class with horrible risk. Reward in an inflationary world. Let me discuss the Social Security situation in more detail because this is a ticking time bomb that will affect everyone's retirement planning. The Social Security Trust Fund is not a real savings account. It is an accounting fiction. The money you paid in payroll taxes was not invested or saved. It was spent on current benefits on other government programs, on whatever Congress decided to fund. What the trust fund holds is IOs from the Treasury, promises to pay from a government that is already running $2 trillion annual deficits. When Social Security needs to draw on those IOs, the Treasury has to come up with actual cash. And where does that cash come from? Borrowing more debt, more pressure on a fiscal situation that is already unsustainable. By 2033, the trust fund will be exhausted. At that point, Social Security can only pay out what it takes in through current payroll taxes. That means an immediate 23% benefit cut by law, unless Congress acts, and Congress is paralyzed. Democrats want to raise taxes on the wealthy. Republicans want to cut benefits or raise the retirement age. Neither side will compromise, so nothing happens, and the cliff gets closer every year. Here is what I think will actually happen. Congress will wait until the last possible moment, then cobble together some combination of tax increases, benefit cuts, and means testing. People currently in their 50s and 60s will probably see their promised benefits honored mostly, but people in their 40s and younger, I would not count on anything close to what the current formula promises. and means testing is almost certainly coming. It is the politically palatable way to cut benefits without appearing to cut benefits. You just say that wealthy retirees do not need Social Security, so we will reduce or eliminate their benefits. But who counts as wealthy? Someone with $1 million in their 401k, 500,000, 200,000. If you have been a diligent saver, if you have sacrificed current consumption to build retirement security, you might find yourself penalized. Your Social Security benefits might be reduced precisely because you were responsible. This is the perverse logic of means testing. It rewards those who spent everything and punishes those who saved. I also want to discuss something that does not get enough attention: the psychological damage that market volatility does to 401k participants. The system requires you to watch your account balance fluctuate, sometimes dramatically year after year. This constant visibility creates anxiety that leads to poor decisions. During the 2008 financial crisis, 401k participants withdrew or stopped contributing at exactly the wrong time. They locked in losses at the bottom. They missed the recovery. Studies show that the average investor underperforms the funds they invest in by 2 to 3% annually, primarily because of poor timing. They sell low and buy high, driven by fear and greed. The old pension system did not have this problem. You did not watch your pension balance fluctuate. You did not make investment decisions. You just worked your years and received your benefit. The volatility existed, but it was hidden from view, managed by professionals, absorbed by the company. You could sleep at night. The 401k system forces every participant to be an investor, whether they want to be or not, whether they have the temperament for it or not. And most people do not have the temperament. Most people cannot watch their life savings drop by 30 or 40% without panicking. Most people cannot stay disciplined through the fear and the headlines and the predictions of doom. This is not a character flaw. This is human nature. We are wired to avoid losses more than we are wired to seek gains. We are wired to follow the herd, to feel safety in numbers, to panic when others panic. These instincts served our ancestors well on the savannah. They serve us terribly in financial markets. The 401k system ignores human nature. It assumes people will make rational decisions about saving and investing. It assumes they will understand complex financial concepts. It assumes they will maintain discipline through volatility, and then it blames them when they fail. I believe a better system is possible. I believe we could have retirement plans that provide the tax benefits of 401k accounts with the stability and simplicity of traditional pensions. I believe we could have fee structures that actually serve participants rather than enriching intermediaries. I believe we could have investment options designed for real human beings rather than theoretical rational actors. But the current system benefits too many powerful interests. The financial industry makes billions from fees. Corporations save billions by offloading pension obligations. Politicians avoid hard choices by pretending the system is fine. Changing it would require taking on all of these interests simultaneously. I am not holding my breath. So the burden falls on you. You have to navigate this flawed system as best you can. You have to educate yourself about risks that the industry will not disclose. You have to make decisions that protect your interests when the system is designed to serve others. It is not fair. You should not have to become a financial expert just to retire with dignity, but fairness is irrelevant. This is the system we have. These are the rules of the game. Your choice is to learn the rules and play well, or to remain ignorant and suffer the consequences. I have given you the information you need. I have warned you about the dangers. I have explained the mechanisms and the incentives. Now it is up to you to act on this knowledge. Review your 401k this week, not next month, not when you get around to it, this week. Understand what you are paying, understand what you own, understand the risks you are taking, then make changes if changes are needed. Your retirement security depends on it. Your future depends on it. Do not let a flawed system and a complacent industry determine your fate. Take control, take action, and take responsibility for building the retirement you deserve.